All right, everyone, we're going to kick back up with types of retirement accounts. Before I get there, just want to remind you when you go to the assignments tab and you turn in your workshop, remember to turn it in as your last name and then the title of the workshop so that I can keep track of the files. All right, good. So, types of retirement accounts. You have undoubtedly heard these mentioned before, but we're going to demystify them. What's going to happen in this section of the lecture is I'm not going to have everything written on the slide. I'm going to do a lot of describing. I'll be clear when I'm defining. But basically, what I want to say up front is a retirement vessel can be many different things. I mean, technically, we're just saving, right? So you don't have to use any of these. But the particular types of accounts I'm going to talk about are going to offer you advantages as you save for retirement. So rather than throwing all the money under your pillow, you can take advantage of some legal benefits you have as you try to save for retirement. The biggest one is that you get tax breaks. The government has a vested interest in people saving for their own retirement so they don't have to use social safety nets to bail them out. So they give you little nudges here and there, one of which being through the tax code. At any rate, these are some popular types of savings accounts. The first thing or retirement savings accounts, and the first thing we're going to do is talk about the variations that apply to all of them before we go naming various accounts. So the first split in types of accounts is basic versus voluntary. This is very simple. Basic accounts are given to you as part of your compensation as an employee. You don't do anything to get them. You're auto-enrolled, and that's that. Voluntary retirement plans, obviously, you opt into. And so you'll want to be mindful when you get hired of whether your company has a basic plan or whether you need to actually do something to enroll. The second one is more important distinction: contributory versus non-contributory. Contributory plans means that the employer contributes on your behalf into the account. That might be like a basic policy, like those classic pensions that we talked about, where firms, because you worked there long enough, contributed money into an investment account for you and then gave you a pension when you left. Non-contributory, the company does not, or they require you to contribute and they might do some matching. So a lot of non-contributory stuff out there. This isn't dichotomous. This isn't this or that. Vesting and matching are two related concepts. So I'm going to talk about contributory versus non, and vesting and matching using the example of Humana. So Humana is an insurance company based out of Louisville, Kentucky, and they offer, they probably have, I think their headquarters is in Louisville. They probably have several offices all over the place. But the first thing we might want to look at is contributions. So this contributions tab, employee may contribute, you may contribute. Most retirement plans are a non-contributory plan in which the employee must contribute funds. So matching. Well, what we could see here is you can contribute as an employee up to 35% of your compensation pre-tax to a 401k. We'll learn about that a little bit more later. Or 35% to a Roth. So we'll learn a little bit more later about that. Matching comes in because Humana can match 125% of your contributions. So what that means with matching is, let's say you have $100,000 of income. Make sure my zero's right. $100,000 worth of income. Humana says we're going to match up to 6% of your compensation. So you make $100,000 and you contribute 6%, 0.06. Then there's going to be $6,000 in your account on your behalf. That's your money. Humana says they match 125%, so Humana's also going to put in $7,500 because they're putting in $1.25 for every dollar that you put in. So what in total will you have in your account at the end of the year if you put in 6% of your income? Well, the $7,500 from Humana and the $6,000 that you put in, $13,500. So that's how matching works. A lot of employers that have employer-based plans will offer some sort of matching, dollar for dollar. Actually, 1.25 per dollar is a very good matching ratio. However, there's something in the background called vesting, and this has to do with the money that the company gives you. You are always 100% entitled to the money that you put in your retirement account. That is always yours. The company's matching, however, is going to be subject to vesting. And what vesting refers to is the amount of time you need to work at the company until that money becomes yours. So, Humana says you are vested for the money that they give you if you work for the company for 2 years. This is called cliff vesting. After 2 years, all the money they put into your account is 100% yours. There's also different types of vesting called graded, in which maybe you work there 2 years and you get 50% of the money, and then you have to work another 2 years before you get 100%. Vesting just basically deals with if you were to leave at any point, do you get the company's money that they matched with? Well, if you work for more than 2 years for Humana, it sounds like you do. This seems like a really generous policy too because it is 2 years and it sounds like it's a blanket one. So as you work your third, fourth, fifth year, all the money they give you doesn't require an additional 2 years. It's just yours. All right. So matching funds have to be vested. So you got to work long enough to receive the match. You really want to contribute every dollar that the company will match because you're giving away free money if you don't take advantage of maxing. So I can't give you personal financial planning advice, but I will tell you if you don't contribute 6% of your money, you are giving away free cash. All right. Now let's take a look at defined benefit versus defined contribution. These two types of plans differ in the way that you are paid. So let's start with defined contribution plans because they're kind of the more common. Defined contribution plans mean that you have a contribution requirement to the fund. So you need to give maybe some minimum amount, etc. Whatever your contribution requirement is to the fund, to the plan. And your benefits are simply whatever the fund earns, right? So you're going to choose your investments, and then whatever they earn is yours. Defined benefit, however, has a fixed benefit payout. You'll see this a lot with government jobs. For example, we're going to pay you each year in retirement 75% of the average of your 3 highest earning years, something like that. What this means is you can't do anything about your earnings, whether the investments they use earn 12% or 4%, you get this defined benefit, this defined payout. And you might have to do something like contribute 2% of your income for every year for 30 years while you're working. So the benefit is fixed based off of some formula, and your contribution has, you have to contribute some amount each year. Defined contribution is the contribution amounts that you make are fixed, but the earnings can be whatever the earnings of the fund are. And then lastly, we have employer-sponsored versus self-directed. And so these require a bit more explanation. Employer-sponsored plans are plans that come directly from your employer. A very basic one you'll see is profit sharing. And what happens here is the company sets up on your behalf a retirement plan, and they pay into that plan if the company is making profit. So having a profit sharing plan is ideal for companies because they give consumers a vested interest for the company to do well. And so people arguably would work harder because the profits come back to them. However, this is risky for a retiree, somebody who's trying to retire, because if the company goes under, so does their retirement. The more popular ones are salary reduction plans. These are ones in which the company takes a fixed amount out of your paycheck every month and puts it in a retirement account on your behalf. And the two common ones of these are the traditional 401k and the Roth 401k. You've probably heard about these before, but what the 401k part just refers to tax line in the tax code and deals with employee benefits. So traditional 401k, what goes on with this is we have pre-tax contributions with taxation when they're withdrawn. So if you contribute to a 401k, the dollars come out of your income before they are subject to income tax. So let's say you would have had, let's say you had earned $80,000 in the year. You contribute $8,000 to retirement. Your income before it gets applied to the tax table is not going to be $80,000. They're going to take out the $8,000 and not tax it because it went to retirement savings. So it's a way to give you a tax break today. You don't have to pay taxes on the salary that you put into your 401k. However, you're going to be taxed when they're withdrawn. So what you're actually banking on here is having a lower marginal tax rate when you're older than you are today. Because let's say that you're in the 25% tax bracket now, but you'll be in the 15% marginal tax bracket when you are retired. Well, would you rather pay taxes now at 25% or when you retire at 15%? Well, let's defer those, right? I'd rather pay them when it's lower. So let's do a traditional Roth 401k, not avoid the 25% taxes now and go ahead and be taxed when I retire. In a 401k, you're going to contribute your savings to an investment fund. These earnings are not taxed as well until you're withdrawn. So that gives you a little tax benefit that you're not paying for the taxes today. Okay. The Roth 401k is the opposite. You are taxed on the dollars you put in today, but you don't pay for them in the future. So you would expect maybe having you want a higher standard of living when you're older. You're going to make more income, so you'll be in a higher tax bracket when you retire. You want to avoid that high tax when you retire, so you're going to have your funds taxed today. Earnings are still not taxed until they're withdrawn, as is employer contributions. Those are always taxed when they're withdrawn at the end of or when you retire and not up front. So let's do a little question. If you make $100,000 in taxable income today, but $25,000 a year in taxable income when retired, which plan would you choose? Well, you would choose the traditional because you'll be in a lower marginal tax bracket when you're older, when you retire. Self-directed plans. So some people's employers don't offer retirement plans, but the government still gives you all the tax breaks that you could get from an employer, with the exception that you can't get matching, right? Because that's an employer benefit. But you can select into 3 different types of individual retirement accounts. You don't have to just go without retirement. The first is the traditional. It's just like the 401k, except there's no employer involved. You still take the money out of your income pre-tax and tax it when it's withdrawal, and earnings on investments are still not taxed until they're withdrawn. You won't have any matching, but you will have a retirement account. The exceptions here is that in order to get a traditional IRA, you must not have an employer plan. So you can't get both. And if you have too much money, you won't qualify. So we look here, and this is just for the single filer, but a person making more than $72,000 a year doesn't get the tax break through the IRA. Then we have another type, non-deductible. So there's no income limit on this type of IRA. But you do get the benefit that all contributions are post-tax and you get deferred tax on investment earnings. The last type is the Roth. All contributions here are post-tax, just like the Roth 401k, with deferred tax on investment earnings. Exceptions are that there are income limits on contributions. So if you make too much money, then your contributions don't get the tax break. So you have to be in a certain level of income. All right, those are your types of retirement accounts. Go ahead and zip on over to our course webpage and check out your content browser for today. Go to that checklist. You've probably now read the chapter. If not, give it a read. Sections 4.1 through 14.3, that should say. Point 3 got pushed over there. Watch the video. You've done that now. Complete the workshop. You've probably done that already. And then go ahead and look for our homework. Don't forget to post a comment to the discussion board. Tomorrow, we're going to study portfolio composition, and we're going to talk about diversification. And it should be a pretty cool lecture. And then, of course, Friday, we will have our Quest 2. So begin preparing for that. All right. Have a good day.